There are 5 buyer profiles that should automatically trigger a different lending conversation. Most lenders only handle 1 or 2 of them. If you've ever had a deal fall apart 3 days before funding, or had a buyer walk away because the bank said no, one of these 5 profiles is probably why. Here's what I watch happen constantly. An agent has a self-employed buyer, qualified in every practical sense. Strong income, healthy deposits, substantial assets, but they go to the bank, looks at 2 years of their tax returns, sees an income that doesn't reflect how the business actually performs, and declines the application. Buyer comes back to the agent discouraged. Agent assumes the bank's answer is the verdict, and the transaction doesn't happen. Or the agent refers the buyer to a lender, but the lender doesn't specialize in the relevant product. They attempt a conventional loan on a borrower profile that needs something different. It gets deep into the process, underwriting finds the issue, and the deal falls apart with weeks left on the contract. In both situations, the buyer was qualifiable. The problem wasn't the buyer's financial profile. The problem was the product being applied to it. So here are the 5 profiles. Know these and you'll never watch a deal fall apart because the wrong lender was involved from the start. Profile 1, the self-employed borrower with significant write-offs. Their tax return income doesn't reflect what they actually deposit. We qualify them on 12 or 24-month bank statement deposits instead of tax returns. The bank sees $50,000 on a tax return. We see $42,000 a month in deposits. Completely different qualification. Profile 2, the 1099 earner, independent contractors, commission-based sales professionals, gig workers. Some can qualify conventionally if their 1099 income is consistent over 2 years. For others, there is a dedicated 1099 program that uses 90% of their gross receipts to qualify, bypassing the deductions that tank their conventional income number. Profile 3, the business owner with a professionally prepared profit and loss statement. The P&L program uses a 12 or 24-month business P&L prepared by a CPA or enrolled agent to calculate the qualifying income. This is particularly useful for business owners who have complex financials and personnel to manage the books. It's honestly a much simpler path with a delegated approach for them. Profile 4 is the high net worth individual with significant liquid assets but limited income. This could be retirees, business sellers, people who manage their income intentionally. The asset qualifier program is based on assets rather than income. The assets are tested against a coverage threshold to demonstrate the ability to support the mortgage. No paycheck required. Profile 5, the real estate investor buying a rental property. The DSCR program qualifies the property on its own rental income. The appraiser determines the market rent as part of the appraisal, and that figure is used to calculate whether the property covers its own mortgage payment. No personal income calculation, no DTI, the property qualifies itself. 5 profiles. If your buyer matches any of them, the first call needs to be a lender who does these products at volume, not a bank that offers them as a footnote. Let me show you what this looks like in a real transaction. Restaurant owner came to an agent as a referral. Friend of a past client, solid guy, business had been profitable for 8 years. Agent referred him to a lender they'd always used. Good lender, handles conventional loans well. The lender ran the application conventionally. Everything moved along fine until underwriting. At that point, it became clear that the tax return income, which reflected significant write-off structured for tax efficiency, couldn't support the purchase price on a conventional loan. Deal fell apart 11 days before the scheduled closing date. The agent called me. I looked at 12 months of business bank statements, monthly deposits averaging $44,000. After applying the standard expense factor for the business of that type, his qualifying income on a bank statement program was nearly 4 times what the tax return showed. We funded 21 days later. Different lender, different product, same buyer, same property, same price. If the initial approval conversation had started with the right product, nothing falls apart. That's the only thing that needed to change. The mistake that costs agents transactions in this situation, and I see it constantly, is assuming that a pre-approval from any lender is a reliable pre-approval. A pre-approval is only as good as the product being applied. And a lender who doesn't specialize in non-QM borrower profiles can issue a pre-approval letter in good faith that doesn't hold up in underwriting. It's not dishonesty, it's a product knowledge gap, and it becomes your problem when the deal falls apart. So before you go under contract with a self-employed buyer, a 1099 earner, or a real estate investor who want their bank for pre-approval, have them talk to me first. 20 minutes. I'll tell you whether the pre-approval they have is built on the right foundation. So 3 things to do this week. 1, go through your active pipeline right now and identify buyers who fit one of these 5 profiles. Self-employed, 1099, business owner, high net worth with limited W-2, real estate investor. Flag them. 2, for any flagged buyer who is pre-approved through a conventional lender, have them talk to me before you go under contract. Not after, before. 3, text me 2 sentences about any scenario that fits these profiles, who the buyer is and what the situation looks like. I'll call you back within the hour with a real answer. I work with a focused group of agents, and the ones I work with most closely are the ones who bring me these conversations early, not as a rescue after something's already in trouble. Schedule a call or learn more at teamaronheim.com for realtors, or text me at 720-200-5464. If what I described today matches something sitting in your pipeline, let's talk this week.